From Washington, this is the Macrocast, a podcast brought to you by Penta and Markets Policy Partners.
Good morning. It's Friday, December 2nd. You're listening to the Macrocast, brought to you by Penta and Markets Policy Partners. I'm Matt McDonald, president of Penta, joined as always by John Fagan and Brendan Walsh of Markets Policy Partners. Also joining us today is Matt Dell, Orfano, founder of Telamonius Ventures, who's joined us for holiday observations in the past. And I, of course, am always happy to have extra Matts on hand. You can never have too many Matts in the room. So,
agreed.
Matt, welcome to the show. I'm going to kick it off going through the highlights from jobs numbers. So today's Jobs Friday and what we saw in the report. I don't know. I'll be curious for everyone's thoughts on whether this is a good report or a bad report. It's a bit of a Rorschach test. 3,000 jobs created, which is good. The unemployment rate stayed at 3.7%. Of note, that under the hood that wasn't so great is the earnings wage growth was up. I think the annualized rate ended up at like 5.8%, which is not what the Fed is looking to see. Additionally, labor force was down in the household survey, down 186,000. Labor force participation rate inched down too. So you get a little shrinking of the labor force, a little increase in the wage growth. That's not exactly what the Fed is looking for. Interestingly, also under the hood is you had increases in services, declines in some of the good stuff. So retail, trade, warehousing, transportation, that stuff actually went down. We saw decreases there, which is an interesting stat ahead of the holiday shopping season. But what jumped out to you all in the jobs numbers? Maybe I'll hand it over to the second Matt President here.
Exactly. Matt President. I think, look, you covered a lot of the topics, and the expectation for the jobs number was probably a little bit lower, mostly because in the last couple weeks of November, and it's obviously always hard with the holiday, some of the surveys that people look at that include, claims for unemployment benefits, et cetera, started to look a little bit more robust, which generally indicates a slowdown. We've seen that a couple times. There was sort of a false start on it over the summer. But a lot of that had to do with the timing of when the big auto companies had shut down their production lines, because semi shortages were so bad, they shut them down earlier in the year. So it's threw off normal expectations a little bit. That sort of worked through. And so this is the first time we've seen it where there's kind of no excuse that people can come up with. So the anticipation was it was a little bit lower. The folks over at ADP had a little bit lower number. But some of the underlying data at the first half of November, which because of the way the survey is collected matters for the survey, just a timing point of view when it's collected. Yeah. The numbers were generally okay. I think the one takeaway that everyone should be thoughtful about is forget the last 2 years when you look at the numbers, because it was so hard to determine who was being hired back temporarily. COVID was in there, real mess. But in a normal November, big retail folks, and so normal is 2019. And I get it that online shopping has changed things, et cetera, but 2019 is not the worst proxy in the world. You think about somewhere between 350 and 450, maybe even 500,000 folks are hired to be at the perfume counters, et cetera, meet packing needs, et cetera, from ship to store. And normally it's just a big seasonal thing. We deal with it in the jobs number. This year it came in around 250. So my one observation, that's the non-seasonally adjusted number. So it's, if you kind of go under the hood a little bit, that's how many people were added, and it's lower. And I think the takeaway there is that you're, in addition to the surveys that you saw, the claims numbers that people are looking at, the takeaway there is that companies have hired a lot of people. People internally are picking up those hours. They're nervous about hiring more people now, which is the first time we've heard that in a while or seen any evidence of that in a while. So you're starting to see these slowdown elements, and it's going to matter because one could make a solid argument. You mentioned a Rorschach test, but one could make a solid argument that this report is much closer to 100,000 run rate than it is the 260 or whatever that came out on the headline.
Interesting, because of seasonality sides of the dynamics here.
And also, I'm interested in your thoughts. So the market's definitely reacting to the wage growth, which was 0.6. But we also know that we've had a number of large layoffs, and with layoffs comes severance. Do you think that could have played a role in this monthly jump in the wages?
So this one is the monthly wage number, the month-to-month one versus the ECI, which they come out quarterly. Mm-hmm. The important piece to think about there when you're looking at that number is, gosh, it just uses the number of people hired and fired and their average earnings and does the sum product, multiplies those together. So as those mix change happen, it can make for big swings in the number, which is why they straighten it all out with the ECI on a quarterly basis. Now, because we saw, generally speaking, you also have a bunch of education and health services people coming back, just normal course of business. Those folks generally are around kind of we'll call it the average for private payrolls. You have a bunch of these in the numbers. You saw less weighting towards the retail folks, and so the jobs such as professional services, think about accountants closing the year, consultants, that kind of stuff, and information services that generally earn a little bit higher, they stayed a little higher this month on a relative basis. So that skewed the mix. The other thing that skewed the mix a little bit was construction is definitely slowing, but we always lay off construction workers when the winter hits, right? Just because the literally gets too cold. And so this month, actually, we had fewer construction jobs fall off because, frankly, the weather was a little bit stronger. And so those two boosted that average. So I would be really careful about looking at that and making any conclusion because the mix change is so severe in this month.
Brendan, what's your take on this, and where do you think? Let's talk about how I guess on some level, like 263 is this is in line. I think the average across the last 3 months was 280. So we've feels to me like we've kind of come down off that like average monthly run rate of 400 or 500 that was the post-pandemic. Mm-hmm. We're back into, I would call these like normal job numbers for a growing economy. But how do you, on some level, the most important part, it feels like the most important part of the jobs report this month is not necessarily the report itself, but how the Fed looks at and interprets this stuff. We just had Powell's speech this week. how do you, before we kind of turn to the speech itself, how do you think the Fed is going to look at the numbers that we're seeing here? There's Matt kind of went through a lot of the caveats and context. It's always kind of interesting year end, but what are they going to be looking at in this thing?
Yeah. So, obviously the establishment survey is where we get the 263,000. That's also where we get the wage data. But the unemployment comes from the household survey, which is less statistically significant. But the last 3 months, we've seen a huge divergence between the two surveys. So the last 3 months, the household survey has shown over 100,000 month decrease in employment. It was actually over 200,000 this month. So while from a statistical standpoint, the establishment is more important, 3 months in a row, might be saying something that the household survey is picking up something that the establishment isn't. So the Fed is, I think, going to be focusing on the household, the 263, but more importantly, the 0.6% jump in wages. But the reports in total might be indicating a little more weakness than the headline numbers are indicating today.
It's interesting. When you look at the household numbers, that some of the decline is driven by like not being in the labor force anymore.
Yeah. So the only reason that the unemployment rate stayed at 3.7 was because we also lost people from the labor force, which we've been doing the last few months. We had the huge bounce back post pandemic when everyone was allowed to leave their houses again and go to work. But then we've been sticking in that. And part of that could be, COVID related. Some people just don't want to go to work. But the big picture is it very much is demographics related. The baby boomers are reaching retirement ages. This is something we knew was always going to happen. So from a Fed policy standpoint, it's interesting where if wages are going up because we don't have enough people to hire, but the reason we don't have enough people to hire is because old people are retiring and we have a very inefficient immigration policy. is higher rates really going to solve this problem, or is it just going to, put us into a deep recession that will solve the problem of inflation because, we'll be in a deep recession?
Yeah, we shifted from a demand problem to a supply problem with nothing
very quickly. Yeah, and all the indications on the inflation front is the bulk of this was actually transitory. The forward indicators are coming down. The World Health Organization releases their monthly food price index. We're back to where we were before the war in Ukraine. Same with the price of gas. We're back to where we were. So we had that double whammy of the supply chain constraints caused by COVID. We had food and energy price spike caused by the invasion of Russia to Ukraine. And now we're working our way through those. We had a lot of housing inflation because we threw $5 trillion at Americans. And
it's also,
and all of that is coming off. And so, but now the Fed has shifted from worrying actually about inflation to worrying about wage inflation.
Yeah, it's also worth pointing out that the savings that were like a big part of the pandemic dynamic, those are starting to.
Yeah, and the overall numbers, I think, so we have still $1 trillion in savings, but it's massively heavily weighted to the 1%.
Well, and
the average American has already spent it, and we've also seen. So Vanguard released data that they had actually in the last 20 years the highest amount of people cashing out their 401ks for hardship reasons, and Fidelity showed the same, and also the credit card data is showing that people are starting to go back to revolving.
Yeah, the last data on savings rate is back down to as a share of disposable. That's back down to where it was previously.
That's a flow number. I think to sort of put these things together, the savings rate, people are not saving incrementally anymore, and it is true. I would on the $1 trillion that Brendan just mentioned, a lot of that is actually in small businesses, and generally speaking, they skew to older. It's not. I understand when you look at the earnings skew, it looks like wealthier people. It's a true statement. However, there's still a lot of money in the small business accounts, which is a good thing. It's not a bad thing. And generally speaking, that money gets reinvested. So if I'm sitting there as the Fed, you have just gone out and said, hey, we're going to be in the last yesterday, and we can transition into talking about this. But they basically said, hey guys, we're going to look at the data a lot more. And now we're saying, okay, this jobs number on a headline doesn't show the slowdown, but we've just discussed. It's slowing. Like I said, we're probably closer to 100,000 average job number than this 200, 250, right? Clearly out of the pandemic, 450, no question, probably about to take the next step down. With that as the backdrop, but with another 3 months before you can sort of consistently say, hey, we are going to be inflation is beaten, or whatever you want to say, or they can have enough power or communication or evidence to be able to communicate that they think they're on the right track. You're going to be in a situation where the Fed is sort of sticking with their communication policy, probably making the market nervous. I'm not talking about the equity market. I'm talking about potentially causing recession before they have enough room to actually change their trajectory. That's different from a pivot. They're not going to all of a sudden go and say, oh my gosh, we caused recession, but change their trajectory. And that's going to cause a lot of ruffled feathers in the next couple months. I think the likely outcome that everyone should hope for is that we are seeing productivity up in general, right? We just made a comment, there's millions of people who've left the workforce, but the GDP per capita, and the consumption is staying pretty strong, the output of the economy. So therefore, it's likely that productivity went up. That's because people invested a lot in their businesses. Those are great things. So with that understanding, I think hopefully the Fed will have a stronger ability to say, look, while we do have to slow down the rate of cuts, et cetera, we are hopeful and thoughtful that there's actually good productivity out of the economy, and that will allow us to absorb some of the inflation. And so therefore, we don't have to keep raising, but we also think the economy can have a decent outcome. So yeah. I'm hopeful that they're thoughtful about that balance.
Yeah, John, let's talk about the Fed and Powell's speech and market reaction.
But John, even before we talk about Powell's speech, there's two really interesting data points out today. We had the non-farm, But the Cleveland Fed put out a very, very interesting study that gave indications that the Fed is already over tightened.
Yeah, and it's really part and parcel. I mean, they apply, the Taylor rule, and we saw actually St. Louis Fed President Bullard pull out his own formulation, which showed that the Fed was too loose. And so, there's a little bit of sparring.
If you actually knew how to read that graph, it showed that they waited 2 years before they should have started hiking, and they've actually already over tightened. If you read that graph correctly.
Yeah. So there's clearly a robust debate going on within the Fed. We are seeing this spill over into the communications from FOMC members and Fed Chair Powell this week, notably injecting a lot more nuance into their discussion about inflation, about the economy, about labor markets. In the past, it was very one note, right? It was just inflation as this monolithic enemy that we're fighting, and everything else is just noise, and the economy is strong. And, if we have to have, hard landing's a risk, but we've got to fight inflation as job one. And it really has been over the past few weeks, since the November meeting, really, when Fed speakers have come out and put in, a lot more color on the palette of their communications, and trying to talk about how the kind of things that Matt Orfano was referring to earlier, working in some discussion about how they are admitting they're making progress on inflation, which seems evident from the data, and is it needed to be said by Fed. Talking about the slowdown and Chair Powell's commentary on labor markets. Again, like very nuanced stuff, not this one note hawkish. Clearly, they're going to be continuing to tighten, but this is it's maybe not a pivot, but clearly there's a downshift occurring, and markets are reacting to that.
How, John, anything on how markets responded to the jobs report in light of kind of the bookending of the Powell speech, which was, basically the downshift is, there was both anticipation and positive reaction, but for any response on the jobs front?
Oh, yeah, there was a knee-jerk reaction. The sort of good news is bad news, classic. The markets were really leaning into this kind of dovish atmospherics around Fed Chair Powell's speech on Wednesday, and some of the CPI data was encouraging. We've got PPI next week. We've seen mixed growth data this week, and certainly purchasing managers indexes, PMIs, came in very weak. And so that was getting the bond bulls kind of leaning into it. You saw, pretty clearly short covering / dip buying occurring in midweek in the wake of Powell's speech. And, lo and behold, you get a whiplash effect when you get a big number like this. And so we got sell off, but, reflexive sell off in bonds, reflexive sell off in equity futures. But, this is the kind of thing that probably will play through as people kind of look past. The Fed's not going to overreact to one jobs number. And the trends that we're all discussing here do seem to be pointing in one direction, which is softer. It did have a quality of I feel like both Powell's speech and response to it is it was a little bit of a game of chicken of like, are you going to be data dependent or not be data dependent? And the Fed was, they always talk about being data dependent, but it had a little bit of a quality over the past couple months of like, wait until you see the whites of their eyes type of thing. And this was kind of the final concession of fine, we'll pay attention to the data.
Yeah. And the market was so one-way positioned for him to be uber hawkish that as long as he wasn't more hawkish, anything would be viewed as kind of dovish. So you get overreactions one way or the other. And I think, by Tuesday, we'll kind of have washed out the Powell speech and the farm number, and we'll
move on. That's exactly right.
Let's take a quick break. When we come back, I want to pick up on kind of it is holiday shopping season. So when we come back, let's talk a little bit about consumer behavior and retail. You're listening to the Macrocast.
Penta is the world's first comprehensive stakeholder solutions firm. We are a one-stop shop for the intelligence and strategy leaders need to assess a company's reputation and make decisions that improve their positioning. As executives in the C-suite must account for a growing set of engaged stakeholders, all with distinct, fast-changing demands, Penta provides real-time intelligence and strategy solutions. We work with clients solving complex global challenges across a variety of industries. Our clients span technology, financial services, energy, healthcare, and more. To learn more about how Penta can support your company, check out our website at pentagroup.co, our Twitter at PentaGRP, or find us on LinkedIn at Penta Group.
Welcome back to the Macrocast. Matt, let's talk a little bit about what we're seeing from holiday shopping season and the dynamics at play there. I'm actually very curious about this because it does feel anecdotally, it feels like the retail sector is maybe the next to get real cautious after tech on the economic situation. But that's just kind of like anecdotal what it feels like to me. So what are you seeing?
I think we're the big picture takeaway is we're seeing retailers have to make a choice that they are uncomfortable having to make. So let's talk about that choice, and then I think then everyone can use their point estimates and think through what they see in their own areas, industries, et cetera. But we have had a situation where we have gone from a generally pre-pandemic promotional environment, very cyclical, to no inventory, right? We saw retailers raising prices materially, consumers sometimes paying the prices or sometimes just dealing with the out of stock. And because things slowed down and the velocity of purchases slowed down, you had folks be able to balance inventory with price at a higher level, right? And it didn't matter whether it was consumer staples or whether it was fast fashion clothing or whether it was household goods. Now, obviously, household goods, when everyone wanted to fix up their house, had it worse, and the food issues didn't come till later, but overall, same story. Now, at the end of the day, if you're a grocery store, you have to move volume, right? Sure, it's food, so that's okay, but you have to move volume if you're any kind of retailer. And we got the shot across the bow earlier in the year with Walmart saying, hey, look, this inflation thing has really pushed us folks to food. And, therefore, we are likely to have a lower outcome in our earnings due to some of these goods issues. But this is coming from a retailer that has historically done incredible service for the consumer in pushing on their suppliers in a way which is unprecedented, right? And they, on their earnings calls, et cetera, openly discussed that their suppliers didn't have capacity. So now they have this capacity is starting to come back. The Walmarts and who are trying to serve their customers and sell volume are taking price down. And we're seeing this trickle in across the board. At the same time, we're seeing, generally speaking, consumer spending slow down, right? So the promotional environment, we will likely have a lower volume and a lower price environment. And the result is that retailers are going to have a lot of difficulty both projecting how much money they're going to make, their margins next year, as well as making sure they're priced competitively. And you're seeing that come across. We saw a lot, obviously more promotion this year than last year during Black Friday, Cyber Monday, et cetera, which people get all fired up about. But the reality was the volume didn't manifest as well as people had hoped with the price cuts and with the promotions. So in general, is it a slower season? It is. Is that all because the consumer is in a really bad spot? It's not. It's because you're going to see pricing come down and the average sales across the economy and retail will be lower for price and volume reasons. So I think your takeaway from that is when consumers are waiting on price and there is opportunity for active retailers to push pricing down, which will result in continued compression in goods inflation, but also continued compression in the margins for the retailers. So as we carry that forward into other analysis, what's the Fed going to think, et cetera, you do have less spending, and there are reasons that will be observable. As for the markets, equity impacts, obviously everything is individual retailer specific, but do understand that it will cascade. It will cascade through advertising spending. It will cascade through internet profitability, and it will cascade through the actual retailer earnings as well.
Yeah, we saw real differentiation in the earnings. We saw Walmart come out and really impress analysts, and their stock went like positive on the year, which is no small feat in a year like this. And then you saw Target come in and have a story that tracked, very closely some of the headwinds that you just laid out, the having to discount and get rid of margin. Is Walmart going to be able to keep it up, or is this something that, they kind of had a confluence of events boosting them with, more higher value shoppers coming in and buying their food there and that sort of thing?
The higher value. Look, taking out one quarter's results, Walmart, I can't speak for them, but I would imagine if I were in their position and I had to have very frustrating conversations with suppliers for 2 years, and had to deal with that and absorb that and diffuse it with my own cost cuts, my own shipping network, my own fixed cost coverage, I would imagine that they are not going to be subtle with their requests for these suppliers in the next year. I think that bird is coming home to roost, and they are going to take every opportunity to drive volume by bringing price down with their leverage just because of their size. So
how big of a deal is it that shipping rates are now, especially from Asia, back to the same levels they were pre-pandemic? For Walmart. Yeah.
Well, for Walmart in particular,
someone that has, obviously a smaller guy, you just take what you, but can Walmart, even use those kind of margin compression even more?
Yeah, look, a big driver of all these costs for these guys in any given quarter is diesel price. You just have to be honest about it, right? So in any one quarter the next, but generally speaking, it's a big deal. I think that helps the shipping costs coming down, helps cover some of the shortages with some production issues still going on in China. But the reality is that you've seen all of the spot rates. So that's the rates, the non-contracted trucking rates, whether it's full trucks or less than truckload or whatever. You've seen that actually come and become much more conducive to being able to get a truck when you need it. And so as a result, that will all get passed through. Good for consumers, yes. Pardon. But for businesses, they're likely going to have to deal with lower margins. That it's very a vast oversimplification, but an easy way to think about it. If you are a company that sells something for $1, 100 cents, and your cost, your gross margin cost is 50 cents, and everything in the economy goes up by 10%. Right? You go to your customer and say, hey, sorry, I got to raise my price 10%. The customer says, okay, I see the inflation number. Sure, 10%. You now charge $1.10. But your supplier came to you and said, hey, I'm jammed up, man. I have to raise your prices 10%. You say, okay, I'll accept it. But they raise their prices 5 cents, not the 10. So now your percentage margin is higher, right? You've actually increased your margin because your price increase on the nominal 100 is higher than the price increase on the nominal 50 that you're paying. There's a million other factors, labor and all these other elements that go into what a retailer actually makes, but that lift will start to recompress, and we'll have to deal with that at businesses, whether they're wholesale suppliers, whether they're part suppliers, air conditioning distributors, construction distributors. All those folks will see the upward margin benefit of those price increases be consumed by labor or the lack of the ability to raise price again this year.
And that's one of that really is the last thing you said there is really key. The lack of ability to continue raising prices. And that tracks with, a lot of the things that we're seeing that, the pricing power only takes you so far. And it seems as though, the ability to pass those on to the consumer is waning.
Yeah. It's an easy thing. And think about business to business. When you think about hardware stuff, pipes, fittings, fasteners, whatever, they went for 2, 3, 4, 5 price increases over the last 12 to 18 months. So now what are they going to do? Show up in March with a slowdown in volume and say, hey, can I get another 5%? Yeah. People are going to be like, forget it.
Well, Matt,
so that's going to,
to your earlier point, this is like for the generation that's running these companies, this is a historically difficult environment to navigate because you're coming off inflation and pricing demands and your input costs and all this sort of stuff straight into, a potential slowdown that you want to plan for and account for. But that's a big fat neck snapping switch to make, and to be able to land. That's as difficult as the trick, the soft landing that the Fed is trying to land.
Sure. Look, I'm a wild optimist about America and the economy here. I think our productivity, our investment in the economy has been fantastic at the business level. Businesses have had to deal with it, and they've dealt with it. And now we can make up a lot of this difference with a higher nominal output and be in pretty good shape. So I'm actually I understand that the next year could be a little rough, but I'm wildly bullish on the outcomes here. I still think we have
business cycles, but I think our economy is much more reflexive than it's ever been, and that's not fully understood by a lot of policy.
It's amazing. I mean, can you imagine if someone had in 2019 said, "Hey, we're going to take 4 million people out of the job force and your productivity and allow basically no immigration, and you're still going to have the same output?" They would have laughed at you.
Yeah.
So I don't know. I'm an optimist. I understand it's crummy and there are people in tough spots, etc. But I'm very bullish on our ingenuity and productivity actually making up for some of the difficulties and showing real flexibility in the economy. And as we onshore more things and have more productive capacity that can flex, I think we get in an even better spot. It's going to take 5 years.
I am going to take that holiday cheer and wrap this sucker right now. Thank you, Matt. Thank you, Brendan. Thank you, John. Thank you, everybody, for listening. This has been the Macrocast. We will see you next week.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.